Hey guys, it's Willie. Today I want to take a look at IBM Stock. Really boring sort of tech company as compared to something like Apple or Microsoft. Really old tech company, but I think from a valuation standpoint this is going to be interesting. As you can see, it's trading at $123 over the past year. You're up 6.7%, which is pretty good for a company like IBM, a really boring company. And so, there is some volatility in there, but boring company, they don't get a lot of coverage. So I want to flip over to the spreadsheet. Let's glance at our financials, do a little forecasting, and see what sort of valuation we're looking at for IBM if we bought it today. Alright, now that we're in our spreadsheet, I want to go over some of the, dismal numbers for IBM. Revenue down, net income same story, down, free cash flow is flat. I think you're seeing the beginnings of a turnaround for IBM. I think they're looking at changing a few things, making some strategic decisions and turning things around, but the revenue numbers and net income numbers are what worry me. You're looking at minus 4% a year for revenue, minus 10% a year for net income. That worries me. Usually for a business, at this point I would be out. I would say, you know what, I'll move on to another business. However, I think IBM is interesting because of its valuation and its free cash flows. To see net income dropping yet free cash flow remaining relatively flat, there's a bit of a discrepancy there that I think is interesting enough to proceed forward to do some more investigation. Shares outstanding coming down at minus 3%. That's good for rewarding investors, giving us a higher percentage ownership of the business. However, I guess I can understand it. IBM is undervalued. I think that it is intelligent to start buying back shares. Also, it saves them from paying out such a dividend from flat free cash flow. So even though they're increasing their dividend, you're seeing free cash flow staying flat. They can save themselves by using what's left over to buy the shares. However, I think they're using free cash flow and they're buying back the shares and they're paying out the dividend, and I don't know how much free cash flow that leaves over to reinvest in the business and grow the business. That would be something to really kind of dig deeper into after this sort of initial screening process. But it will be worth looking into to see how much free cash flow is left over for reinvestment in the business to kind of see a turnaround from, to stop these sort of numbers from falling and start growing this free cash flow number again. On to earnings and free cash flow per share. Earnings per share is down even though they've been buying back. It's just a large drop in net income that you've seen. Free cash flow per share is actually up because you've seen flat free cash flow and decreasing shares. So you're taking basically the same number and dividing it by a lower number of shares to get a higher number of free cash flow per share. On to the sort of debt and asset section. IBM has a good bit of assets going on, which is okay. However, when we go on to debt, you're seeing basically the same amount of debt as assets. Not a whole lot of cash compared to other tech companies. You're seeing quite a bit of debt left over, which has been growing, I think, to kind of fund the business with the falling revenue and net income. Dividends are here. They're growing. I don't know if that's a good sign or not. With flat free cash flow, I would say it's bad. However, growing dividends are good. Good signal for the business. IBM's a bit strange. It's a lot to wrap your head around with, some numbers falling, some flat, some growing. It's a bit much. But yeah, the debt level, something to look into. ROIC, surprisingly good from what I would say is a dying company based on their revenue and net income. But yeah, really good return on invested capital from IBM. onto our metrics. PEs. The current PE makes it look like it's expensive. The 5-year PE says that it's cheap, and our free cash flows say it's really cheap. So I think we lean on the free cash flow here, since it is such strong free cash flow, and unfortunately earnings have dropped so much. I don't quite understand why earnings have dropped and free cash flow has stayed flat. But I'm going to rely on free cash flow, since that's really our focus as investors, is free cash flow. Debt is high, 8 times your free cash flow, almost 9 times. I think that's something that you should understand definitely before you invest. Revenue and earnings growth are down. You're seeing negative growth. That's another thing. Look into the turnaround story here. Free cash flow is actually up 2% over the past 5 years. They're buying back their shares, which is great. And you're seeing a solid return on invested capital from IBM. Now on to forecasting, which is a bit strange, since the free cash flow is flat and the net income is falling quite significantly. I have said minus 2% over the next 10 years. I think you're seeing a competing story of the history of falling numbers, and you're seeing a different sort of output from management saying that they're going to turn around the business and they're going to get that growth back. And I think IBM should be given credit to a certain extent, and hope that they can turn this around. I think IBM can. I think they have the resources available to them to where they can start turning the business around. They definitely have the opportunity to. But I said minus 2%. I assigned 15 multiples for price of free cash flow. That's just kind of my default number that I go to. As you can see, you're seeing very different numbers forecasts for free cash flow and net income. Is just because net income and free cash flow appear to be very different numbers in this business. Definitely try to understand why in your further research. $200 based on free cash flow, $76 based on net income. If we come over here, we average the two, you get $145.90 for your price in the next 10 years. You're in at $125, you get these free cash flows, you're out at $145.90, and you've got a 17% annualized rate of return. However, if you look at, since there is such this large discrepancy, I want to weight the free cash flow at 100% to get our price target in 10 years, and that's giving us a 20% annualized rate of return, which is really, really good. It would just depend, I guess, if you're looking at these numbers and saying, okay, give it a 10 PE, a 10 price to free cash flow, you're looking at 17%. If we weight it back to normal, what are we looking at then? We're looking at 14%, so you need lower growth, minus 4%. Let's see where that takes us. Still 11, we'll call that market. So you're looking at minus 4 and a 10 PE to get a market return. I think it's because of the strong free cash flows that IBM has, and the relatively, I would say, fair price of the business, in that we're seeing such a strong return even with these really bad numbers. Forecasting forward negative numbers is never a good thing, but yet we're still seeing this positive return. Do your due diligence, look into the debt, look into why the net income and free cash flow are so different. Come up with your own numbers, what you think is going to happen. Do you think IBM is going to turn it around? I don't know. But yeah, I think IBM is definitely interesting right now. Yeah, that's about all I have to say about that. Put comments down below. Tell me what kind of stocks you would like to see in the future. I will give them a glance and see if they're worth doing. I'll see if I can get to them as best I can. Comment, just put them in the comments. I'll read them. Like, comment, subscribe, all that stuff that the algorithm wants you to do. And beyond that, I will let you guys go. I don't have much else to say. So I will end the video here, and I will catch you guys in the next one.